Welcome to this ValueBridge.net case study. This time we'll talk about the conventional version of the private equity value bridge, why it's broken, and what you need to do to fix it. The fact is that models typically used by private equity GPs and LPs, and even the academic and industry researchers, fail to capture how debt amplifies equity gains and losses. But we can correct that quite easily. Let's consider a company that grows enterprise valuation from 100 to 180. At entry, it has net debt of 50 and pays that down to 25 by exit. That means that total equity value grows from 50 to 155, so we create 105 million of equity value and have a multiple of invested capital of 3.1. Over the holding period, the company's TTM EBITDA grows from 20 to 30 million, so its valuation multiple goes from 100 over 20, or 5.0, to 180 over 30, or 6.0. According to the conventional value bridge, these three equations describe equity value creation. EBITDA growth is the product of the 10 million increase in EBITDA and average holding period valuation of 5.5. Multiple expansion is the product of the 1.0 increase in valuation and the average holding period EBITDA of 25. And the net debt change causes another 25 million of equity value creation. We define this one as cash flow generation, and so far it's the only value driver that's correct. Well, I should say that it's correct as long as you don't call it gearing or leverage, because that's not what it measures. Positive cash flow generation represents debt that was paid down or cash that was accumulated on the company's balance sheet. It's capital that could have been distributed during the hold, so it's basically a delayed equity dividend that shareholders receive on the last day of ownership. To fix this value bridge, we're going to need to get gearing or leverage into the model. So let's start with a simplified example to see how that should work. Here's the starting point, a company with 50 of equity and 50 of debt. We'll grow the enterprise valuation to 180 as above, but let's hold the net debt constant, so cash flow generation has to be 0. We see that on an absolute basis, the enterprise value and the equity value both increase by the same amount, 80 million. However, on a relative basis, the enterprise valuation only increases by 80%, while due to the smaller cost basis, the equity value increases by 160%. That's how debt amplifies equity gains and losses, and we need to work that into the model. Our first step is to unlever the EBITDA growth and multiple expansion value drivers. We can do that by multiplying by a number called lambda. In an LBO, lambda is always a positive number that's less than 100%, so it reduces EBITDA growth and multiple expansion as follows. However, this leaves a hole in the value bridge, and it's equal to the change in the company's enterprise valuation times 1 minus lambda. We define this as gearing because it tells us how much extra equity gain or loss comes from debt or excess cash on the balance sheet compared to an unlevered alternative that has a net debt of 0. Great, so what is this lambda? Well, you can find one version of it in the academic and industry literature that looks like this. It is a pretty messy formula and it's based on the weighted average cost of capital framework. Now, we don't recommend using this one because it's complicated and it requires data to which we don't always have access. More importantly, sensitivity analyses show that the equation tends to break down and give nonsensical answers under the stress of high leverage or large changes in debt. The good news is that we don't need it because we can calculate an excellent lambda using just the numbers here on the table. Let us define a company's equity ratio as total equity divided by enterprise valuation, so that's 50% at entry and 86.1% at exit. We will also define the debt ratio as net debt divided by enterprise valuation, so that's 50% at entry and 13.9% at exit. It turns out that our best option for lambda is simply the average holding period equity ratio, which you can get from these two numbers. Further, note that the equity ratio and debt ratios always add up to 100%. This means that we can replace 1 minus lambda with the average holding period debt ratio that we get from these two numbers. This gives us a complete description of equity value creation that fully accounts for debt's amplification of equity gains and losses, and it requires no more data than we already had. Let's see how it works. When we multiply EBITDA growth by the average holding period equity ratio of 68.1%, we get 37.4 million. When we multiply multiple expansion by the same ratio, we get 17 million. Our new gearing value driver is the 80 million increase in the enterprise times the average holding period debt ratio of 31.9% or 25.6 million. And cash flow generation is the same as it was before, 25 million. When you add up these value drivers, you see that they correctly bridge the gap between the invested equity of 50 and the realized equity of 155. And that's it, a robust and mathematically rigorous explanation of equity value creation that fully accounts for debt's amplification of equity gains and losses. It uses numbers that can usually be found in GP marketing decks and quarterly reports, and the underlying math is basic arithmetic that you can do on a handheld calculator or even the back of an envelope. Now, just one point on terminology so we don't mix up gearing and leverage. We like to define the total leverage effect as a combination of both gearing and cash flow generation. To get that, you can simply add up these two value drivers, or you can calculate the leverage effect directly. It's equal to the product of the change in the company's equity ratio and the average holding period enterprise valuation. If you plug in the 36.1% increase in the average valuation of 140, you get 50.6 million, which of course equals the sum of 25.6 and 25. So now you know how to fix a broken value bridge. If a GP comes to you with a chart like this and they call the third value driver something like debt paydown, you know that their math is wrong. But you can fix it without even opening an Excel file. Just ask them how much debt they typically use in portfolio company capital structures. If that is 40% on average, you can just multiply the first two value drivers by 60% and let gearing make up the difference. That wraps up this case study. We ran through the mathematics quickly as usual, but you can find all the data tables and equations on the case study page of valuebridge.net. If you are a subscriber, you can also download an Excel template that allows you to plug in numbers for different scenarios and see how they influence the value bridge. Thanks for watching. I hope to see you at valuebridge.net.